everybody. Today we're going to do an end of the month update to the dividend portfolio, dividend income, long term plan. So, welcome everybody, and we're just going to do an update on the portfolio and where it might end up going. I've covered most of the stocks that this portfolio has. Here's one of them right here. It's called QQQI, and it it gets a dividend yield. If you go to Yahoo Finance, you can see in the statistics here, it's got a dividend yield of 15.3%, and then you minus off the expense ratio, and it's in the high 14%. And we're going to look at the growth, and we got two more dividends in the month of May, and then we can project out if we keep everything the same, but we have auto buys set up on these, and then I'm also doing additional purchases. So right now in the account, we've got in the last month, so we're going to cover it's the end of May. So in the last month, this says the whole portfolio grew by 2.37%, and that's just changes in the stocks themselves, because some of these will hardly change at all, and then some of them will change over time. Like if we look at the QQQI, we can go to the 1 year, we can go to the 5 year, and the all time, and see this will be in a range. So with the dividend reinvestments, it will sometimes buy more at the lows, and it will sometimes buy more at the highs, and so the overall portfolio will change, but this is for the last month, so this covers all of May. Uh, Next, let's take a look. I'm not doing like super advanced tracking or anything like that. Just keeping it simple, but we got two more dividend purchases or dividend payouts. So these two are new, $2.01 and $2.84. So we got four payouts in May, and the total for all of these is right here. The total for May is 1546, the total for April, but I think we started this partway through April. Probably why we don't see these other two dividend payouts. And the dividend payouts typically are going to come on a regular schedule. Whatever day of the month that they're going to pay, that will probably be the same. There are some dividends that pay out quarterly. I think I'm mostly choosing ones that will pay out every single month. If you see a dividend yield, let's say, of 10% or whatever it is, what you're seeing is that percentage divided by 12, but for each month. But yeah, if you had, say, a 10% payout yield, it's either, if it pays out every month, you're going to see whatever that would be, your total holdings divided by 12. Or if it pays out once a quarter, it's going to be divided by 4. It would be the same amount at the end of the year. The monthly is just a nice psychological effect because you get to see this more often. It's the psychology of seeing those hit your account week by week is pretty nice. And then it also, when those get reinvested, they technically get reinvested more often, like throughout the year. But over a long period of time, it all averages out. And then lastly, and then I'm doing like a grand total, so we'll see the total through the year. So 1546 for May, and remember we have those auto buys going on, so the total number of shares is going to go up through the year as well. But so far this year, we have 2451. If we turned off all the auto buys, we would expect 1546 for the rest of the year. So we can do a calculator and we can do 1546 this month. Um, we're almost halfway through the year, but 1, 2, 3, 4, 5, 6, 7. So we could do times 7 and add our 905 that we already had. So we'd end up with 117 by the end of the year. But since these are going to get reinvested, it's going to squeak a little bit higher than that. And what else do we have? So these are the holdings that I have, and I'll go through. I'm not going to go get all the yields for you. I did that in another video, but we'll probably do that again. So ACB is just one that I'm kind of following. It's not a dividend payer, and I have extremely little amount of that. But I just curious about it, and what you're seeing in this column on the right is you're seeing this is the total return for each one of these stocks as I'm holding it. So like if we go back to here, we can see the all-time, the 5-year, the 1-year. So throughout all of the buys, throughout all of the dividend reinvestments, this is showing me the return on that stock because they do fluctuate. And as I said before, these stocks, some of them will fluctuate more. I believe JEPI and SPY-I will fluctuate more, and then JEPQ, QQQI, but especially a clause. This is my largest holding, and I'm gonna plan is to eventually balance all of these out over time. But I started getting into this mostly with this clause fund and the so it is my largest holding, but since I started somewhere either the beginning of April or a week before that, overall this holding is up by 1.46%. And as you can see, some of these are down, but they're down less than 1%, and some of these are up less than 1%. But I'm expecting over time for these numbers to pretty much just stay the same within a percentage or two. They're not about having returns on the fund themselves, but we're here for the dividend. Obviously, we don't want them to massively go down. The last one on here that you're seeing is it's a MicroStrategy or strategy related, and I bought a pretty small position in this one. It's not a reoccurring buy. I kind of also just want to see what this does. We'll look it up for you right here. MSTY. I'm looking in the wrong place. Well, normally it just pops right up. MSTY. Well, where did it go? MSTY. MSTY. That's a little strange. I don't know where it went. Sometimes there's a link. Yeah, this is what we want. Well, the distribution rate is about 120%. That's the yield. But here it is. Sorry about that. MSTY. So right now the yield is 124%. And this is going to be a lot more, could be more volatile, right? It's gone up to $30. Right now it's near a low at $20. This is much more experimental, so I also have much smaller position. So we're going to see what the payment is going to come out to be on this, but it's not really like the main thing going on. But if it is a really 100% yield, then even if this ends up dropping down to, even like a negative 20%, by the end of holding it for a calendar year, um, the yield will exceed whatever it drops by, but really, really small position. So we're not really we're more concentrated on these lower ones down here. Um, so 1546 for May, and we're still growing the account. So I'm expecting this number to be hopefully something like $18 for June, maybe $20 by July, depending on how quickly I can put money into it. And as I've told some people, I recommend just even to understand one. There's a few different like retirement calculators and stuff like that you can go through, um, but I think that these types of calculators, I like this one from investor.gov just because it's really simple. There's ones with a lot more variables you can put in, but we are not interested in making it super complicated. You can even find forums and stuff that where people slice and dice like which funds are the best, which ones are riskier or less risky, and like testimonials and stuff. So these are by far not the only ones that people go into. There's ones that follow, like I think it's this fund. Um, I'll write up here. SCHD is one of the most popular, I think. But the yield on it is something more like 4%. But the trade off you're getting is that the overall growth is supposed to be higher, and it's supposed to, I believe it's supposed to follow the S&P 500 or something like that, uh, closer, but the yield is less. So lots of different strategies. This is only one, and again, this is just informational, and we're just going to follow this portfolio. This is not financial advice, but kind of an insight into one way to do things. And so I'm not using this strategy. I'm going with the higher yields, and I'll do the calculation sometime, but I think my overall yield is like if you were to add up these bottom five is somewhere around 10%, between like if you averaged all of them. But the growth on the fund itself is not going to be the same. But you know, investing always takes risks, and you should have, well, some people say that you should have uh, a diversified strategy. So this strategy should be like some percentage of all of your retirement strategy. Some people say you should do switch to this type of strategy like way later in life. But um, so that's that. I learned from some other information that I was looking up that you might, some people say that you might want to pick a strategy, at least if this is, outside of like a 401k or outside of more like on top of a more traditional type of portfolio, that you should invest more based on your personality type and kind of like your risk and stress tolerance. So, for example, if you were um, if you were more into wanting to just only be in like high growth stocks that don't pay dividends, your portfolio is going to fluctuate a lot more. Or let's say you wanted to do swing trades or yearly trades. I think I know someone that tries to do like 13 to 14 month type trades. And they're having to pay closer attention to the market. They may have to pay closer attention to like worldwide events and political events. It's less of a set it and forget it, and they're looking at larger um, like trends, and they're looking at like which companies are sort of falling off on a regular basis, and where there's new opportunities, so they can make these massive large portfolio moves. And they're basically saying, okay, well, I think this area market sector is a discount during this calendar year, so they're going to buy that. They're going to wait 14 months, 16 months, um, strategizing that it's going to go up by more than 10%. They're hoping it's going to go up by a lot more than 10%. And then they're going to sell off after the 14 to 16 months, and then switch to a different company or a different sector that is more in a discount at that time, kind of like a market, like a business cycle type of thing. And that is a lot less stressful and or could be a lot less stressful than day trading or like weekly swing trades. And people are advised to understand the tax implications of what they're doing as well. Um, but all of those things require more monitoring um, on a more regular basis of what you're holding. So this is a strategy that is a lot like some of the people that talk about SCHD, where they're just going to say, well, I'm expecting this to, pay this 4% yield, and I'm expecting it to, you know, get near to the performance of the S&P 500, so I'm also just going to set it and forget it. This is a pretty similar type of thing where we're just going to try to set it and forget it and just watch the dividends roll in. So it's kind of like I see it as a very low stress, maybe the lowest stress way to do a dividend strategy. So we'll do a calculation. I do encourage people to try this for themselves. So let's say we start with $2,000, and we're going to contribute $300 a month. Let's do 35 years. Um, so I believe my average interest rate between all of them is about 10%. We'll do a variance of 1, so it's going to calculate for 11% and 9%. And then we're choosing monthly payers. If all you had was quarterly, you would want to choose this quarterly to get more accurate, but over that amount of time, the difference isn't too much. So let's do the monthly and then calculate. And once again, this is one of the more simple calculators, right? And there's ones where you can put in a lot more stuff. One of the ones that this calculator doesn't do is it doesn't take in account the growth of the funds themselves. So, like SCHD, you're also expecting it to not only pay the 4% dividend, but you're also expecting it to grow about 9% a year, or maybe 8% a year is more accurate. Um, and so you would need to put that in. But because this will at least give you an idea of things you can shoot for, which, a lot of this I see as psychological. You want to see, if you were to do this, if you were to live more frugally, if you were to prioritize this at least for a period of time in your life, the psychological effect of seeing what could happen over that amount of time, and at what point could you live off the dividends. You don't have to necessarily get super detailed if you're more just looking for inspiration. If you're more of a nerd and you need a lot more details, maybe use one of those other calculators. So this is saying in 35 years it's 1.2 million at the 10%, and that's if we still keep it at $300 monthly contribution for all 35 years, and that's assuming all the dividends are reinvested for all of that time. And then you can go down here and you click show table, and it'll show you year by year. One of the things I like to do is I like to look at what is the dividend income at a certain year. So we can do that now. Let's pick year 11. So what we're going to do, and we'll just, do rough numbers, because this is much more about inspiration than much else. Let me zoom in a little bit more. Oh, we can't see that there. Okay. So year 11, it's saying 77K. And you could also use these as like ideas for what you start with, right? We only started with $2,000 for this one, but if we were to start with $77,000, where would we get? But let's say you did this from age 30 to 41, just this. And we'll do one more recalculation if you had a higher contribution. Um, so it's saying before that we had 66. Just going to round this off. Excuse me. We're going to do 77K. And then the year before that was 66. So 77 minus 66,000 is 11,000. And then also we put in $300 a month. So we need to minus that too. So $300 a month times 12 months, 3,600. So we're going to do 11,000 minus 3,600 is 7,400. And then what we can do divided by 12 months. So at that 11th year, we should have $600 per month in dividend income. And you can figure out, what would that pay for? Would that cover a car payment? Would that cover a part of your rent? Would that cover half your rent, or something like that? Um, and then let's do the 20 year. So it's saying down, Let's do the 21 year. So this is saying at year 21 of doing this, 270,000. And then the year before that, we're going to minus the 240,000. That's 30,000, and then we still have to minus off the 3,600 we're putting in. So that's 26,000, and then we can divide by 12. So at year 21, if we just continue to do this, we didn't take any money out, it'd be $2,200. That's per month, or $26,000 per year. Another fun way to look at it is just divide it by 2. And you could say, if you just stopped the reinvestments at this time, you could have 13K every 6 months. And you can imagine what you could do with that. And, long term, the eventual idea is to get your dividends in the 100K range per year. Oops. 100K per year, and then divided by 12. And you would have to consider taxes depending, that situation. But we can kind of roughly see at this rate, we're approaching that 100K by year 33 and 34. We're definitely getting there. So a lot of times with the funds I've chosen, if this were to keep up, you'd usually say, you need to get up to $1 million, and that's going to get you to that 100K mark. But maybe you don't even need that. The 100K is getting you $8,000 a month. But I mean, we can even do this. Let's say we stop at the point at which it's doing about 80K. Divided by 12, $6,000 a month, close to 7,000. We can average out the what taxes would be. So let's do this one more time, but let's change this to, let's say we saved 500 a month, or we put 500 a month into this plan. We'll keep everything else the same. We'll keep our starting investment at 2,000. Calculate. So our final result didn't quite double, but we didn't quite double our contribution, right? But we're going to get to that $1 million. Last time we got to the $1 million, I think at year 34. This one we're going to get there at year 29. So that's 5 years sooner. And if we did that calculation, we'd still have to minus off what we're putting in, which is different, right? So with $300 a month, $3,600 a year, $500 a month times 12. So we're putting in $6,000 a year, but that's per year. But we want to compound this so that eventually it's paying $6,000 a month back to us. And you can imagine at that point, most people probably wouldn't need to work anymore. And so that's the power of this. Since we're online, let's do one more. Let's say we did the 500, but let's say you were able to start with 10,000. So I want to see what year we're going to get to that million. Now we're getting there at year 28, which is 6 years sooner than the year 34. Let's do 20,000. So I just change it from 10,000 to 20,000. Oh, and we went from year 28 to year 27. So we retired or something like that, maybe a year earlier. From what I can tell, what is more important than your starting investment, obviously this will speed things up. From what I can tell, what is a little bit more important is getting this monthly contribution up. Like I can drop this back down to 10,000, and but if our monthly contribution, if we get it up to 800 a month, which that would be if we did 800 a month times 4. So that could be 25% of your income. Um, so we dropped this back down to 10,000 as an initial investment, but we put the monthly contribution up to 800 a month, and that's going to get us there way sooner, I believe. Now we're at a million at year 25 rather than year 28 or year 24. So that's to me that's the biggest difference. Even if we change this back to our initial 2000 starting investment, but we keep this at 800 per month, calculate. Yeah, we're still way ahead. Um, Look, it still says we're starting with 2000 in the account, but we're hitting that those bigger numbers. We're hitting that $1 million mark at year 25 instead of year 34. Um, Same initial investment as the first one we ran, but uh, but we're getting there 10 years, 9 years sooner. Um, so hopefully this inspires you, and we're going to continue to follow the portfolio. I've seen other types of dividend tracking types of channels, and um, not all of them show their starting point, but when you see these start, they always start really small. $15 a month doesn't seem like a lot right now, but the plan is for this to compound and compound and go back to 500 a month. So even 5 years from now, um, we can figure out the monthly on this, right? So if we kept this up, 500 a month times 12 months. So right now we're getting $15 a month, but at year 6, so we'll do 52K minus 42K, and then we minus the 6K that we put in. It's 4,000 a year in dividends, and then divided by 12. So you can see if we kept that $500 a month up, starting with 2,000, at year 6, we should be instead of $15 a month at year 6, we should be up to 300 a month. So 72 videos. If I did one per month with an update, In 72 videos, this should be 330 per month in this column. So thanks for watching. Let me know if this inspired you to try any of this out. I know there's lots of forums, but let me know if you think that these are good strategies to go with. And the one that really caught my eye was the CLOZ fund. And I did read somewhere that so the special type of fund this is not the only one. Actually, we can even see um, CLOZ. And again, there's lots of other places to get your information. Here's the 5 year, and we got to buy in this dip, which was nice. Um, but the yield right now is 8.6. Expense ratio is 0.5. You can see here and here. Um, but what this website sometimes does, it says people also watch. And down here, they're not all the same, but they have some similar types of funds. So I did read somewhere, for example, so this is, I don't know everything about this, but it's something like triple B rated debt holdings or something. So we can find, uh, did this change? Oh, people also watch. So, sorry, I can't see this. Right here, it says people also watch. Sometimes this lists similar types of funds. This is a triple A. Here's another one that's this. It's this triple B fund. Let's click on this one. And if we do the 5 year, very similar shape, had this dip back in April. Should hold pretty steady around the 47 to 49 range. Um, this one has a slightly smaller yield, but it's in a similar range. Somebody told me that you can take these similar types of funds. Um, I heard that the CLOZ one was good. Um, you can find these similar types of funds, and the smart thing to do is to equally branch your holdings between them. This one has an even lower yield. So you can see why I like CLOZ, because it's got like the highest yield in this category. Um, but they said, at the end of the day, any one of these funds could have some issue. They could have the risk. There probably are different risks, but any one of these yields or these funds could have a lawsuit, a change in management, something, and instead of having all of all your eggs in one basket, instead of having all of them in CLOZ, you could spread them out into 4 or 5 similar types of funds. Um, like I believe JEPI and SPYI are similar. So if I'm equally balanced between these two, um, if there was some issue with like that, think of it like that company itself, it would more likely only happen to one of them and wouldn't affect the other one. So there's always risk, but otherwise, thanks for watching, and looking forward to seeing the next dividends roll in.